IAS 8 is one of the accounting standards, one of the older ones, and it underpins really some of the key principles of how we account for things. It's not the most exciting standard. To be honest, it's my least favourite, but it covers accounting policies, accounting estimates, and errors. And it's one that is always considered when other new accounting standards are brought in. So the first aspect of this is accounting policies. Now these are the rules that you actually follow as an entity. Now there are not many accounting standards now that have a choice in policy, but if you do have one that has a choice in policy and you change the policy you apply, so for example you might, instead of charging depreciation to cost of sales, you might now charge it to admin expenses. Well, that is your policy. Now if you do that, you have to apply it retrospectively. So you have to change the previous year's financial statements so that your margins are not skewed year on year. So you apply it to the prior year financial statements and you would adjust the opening retained earnings so that the impact of that standard, the impact of that policy has always been applied. Now if a new standard comes out, that's maybe where you would also change your accounting policy. And you would often have to apply that retrospectively unless the new standard specifically says you do not have to go back and apply this. And IAS 16 PPE has the cost versus revaluation model, and that's one where they say if you change from cost to revaluation, you don't have to apply that retrospectively. Because to do so, you'd have to look back at the value of the assets over many years, and it wouldn't be useful information. Now, much more simple than accounting policy changes and much more common are accounting estimate changes. They're in loads of accounts. So provisions, allowance for irrecoverable debts, allowance for inventory, impairment of assets, useful life of assets. There's many estimates that companies make. Now those estimates, as they suggest, are kind of informed guesses. And if they change over time, you don't go back and change the prior year accounts. You just apply these prospectively, so when you've got more information or you update your estimate, you change it going forward. No prior year adjustment, you just apply it in the year that you change and go forward from there. Nice and straightforward. Prior year errors are really quite rare, but they're a material error that was in last year's accounts. That's not an estimate that you got wrong, that was an actual fundamental error that was in last year's accounts. Well, if that's the case, as you would probably imagine, you have to restate the prior year so that you've got comparability of what the figures really should have been with what they are in the current year as well. So IAS 8 really underpins a lot of accounting standards. So when other new accounting standards come in, they consider, do we have to make people apply this new policy retrospectively or not? Whereas estimates, they change all the time, and therefore you just change those in the year that you change your estimate and going forwards.